Banking in India. History of banking. Banking in India started in 1770 with the establishment of Bank of Hindustan. Later, three presidency banks were set up. 1. Bank of Calcutta in 1806. 2. Bank of Bombay in 1840. 3. Bank of Madras in 1843. These banks worked as quasi-central banks for many years. In 1921, all these three banks were amalgamated to form the Imperial Bank of India. Imperial Bank of India continued functioning till 1955, after which it got renamed as State Bank of India. In 1922, the Royal Commission on Indian Currency and Finance was established under the chairmanship of Hilton Young. This commission recommended the operation of money management in 1926. Based on the recommendations of this commission, the Reserve Bank of India (RBI) Act was passed in 1934, which came into effect on 1 April 1935. Initially, 1935 to 37, the headquarters of RBI was located in Kolkata. Thereafter, it is situated in Mumbai. RBI continued to work as a central bank of Burma till 1947, to Pakistan till July 1948. Nationalization of banks took place in 1969. 14 private banks were nationalized in 1969, and in 1980, 6 more were nationalized. Post 1990s, many nationalized banks amalgamated gradually. Reserve Bank of India (RBI). The RBI was set up on the basis of the recommendations of Hilton Young Commission. RBI was established in 1935 in accordance with the RBI Act 1934 and is India's central banking institution. It started its operations on 1 April 1935 during the British rule as per the provisions of the RBI Act 1934. RBI started as a shareholders' company, i.e. privately owned, but it became nationalized in 1949 under RBI Transfer of Public Ownership Act 1948 and thereafter is fully owned by the Government of India (GO). The first governor of RBI was Sir Osborne Smith, 1935-37. The first Indian governor of RBI was C.D. Deshmukh, 1943-49. Manmohan Singh was the only Prime Minister who till now has also served as the governor of RBI during different spans of time. At first, RBI's main office was located in Kolkata. But it was moved to Mumbai in 1937. It has 4 zonal offices and about 22 regional offices. The emblem of RBI is a tiger, earlier it was lion and a palm tree. The RBI is entrusted with a variety of roles, including overseeing the monetary policy, regulation and supervision of the financial system and the payment systems, management of foreign exchange, issuing currency, promotion of national objectives and crediting short-term loans to government. The preamble of RBI describes the basic functions of RBL as to regulate the issue of bank notes and keeping of reserves with a view to securing monetary stability in India and generally to operate the currency and credit system of the country to its advantage. Earlier, the accounting year of RBI was from 1 of July to 30th of June. But from 2020 to 21 financial year, it has changed to 1st of April to 31st of March. RBI has 4 fully owned subsidiaries, namely 1. Deposit Insurance and Credit Guarantee Corporation, DICOG. 2. Bharatiya Reserve Bank Note Mudran Private Limited, BRB and MPL. 3. Reserve Bank Information Technology Private Limited, RBIT. 4. Indian Financial Technology and Allied Services, IFTAS. The affairs of the RBI are governed by a central board of directors which comprises the following 21 members. Official directors, which include governor plus not more than 4 deputy governors, for a tenure not more than 5 years. Non-official directors, which include 10 directors from various fields, nominated by GOI and they hold office for 4 years. 1 director nominated by each of the 4 local boards of RBI. 2 government officials nominated by GOI. Governor and deputy governors of RBI are nominated by GOI and they have tenure not more than 5 years. The governor of the RBI draws his powers from the RBI Act. He shall have powers of general superintendence and direction of the affairs and the business of the RBI. Presently, the Reserve Bank of India has Shri Shaktikanta Das as the governor and 4 deputy governors, namely Shri T. Rabisankar, Shri Mahesh Kumar Jain, Dr. M.D. Patra and Shri M. Rajeshwar Rao. Functions of RBI. 1. Issuer of bank notes. RBI enjoys the monopoly of issuing currency notes except for 1 rupee note. The 1 rupee note and the coins of all denominations are minted and issued by GOI and not RBI, but they are circulated through the RBI. The RBI adopted the minimum reserve system for note issue since 1957, according to which it has to maintain gold and foreign currency reserves of worth 200 crore, out of which minimum of 115 crore should be in gold. 2. Banker to the government. RBI acts as a banking agent and financial advisor to the central as well as the state governments. It manages government accounts and treasuries. It performs the functions of crediting loans to the governments without any interest for short term. RBI buys and sells government securities, GSECs, on government's behalf. It gives monetary and financial advice to the governments. 3. Bankers Bank. All the other banks in the country keep their part of cash balances with RBL as deposit to meet the liabilities in the time of crisis scheduled. Scheduled commercial banks keep cash balances in 2 ways. A. They keep part of cash balance with themselves, and B. The other part is kept with the RBI as deposits. 4. Lender of last resort. RBI is not only a banker to the banks but also a lender of last resort. That means, in times of crisis, the scheduled commercial banks approach the RBI to get financial assistance. As RBI is the lender of last resort, it gives opportunity, enabling itself to exercise control over the banking system of the country. 5. Custodian of foreign exchange reserves. RBI functions as the custodian of nations' foreign exchange reserves. In order to stabilize the rupee's external value, the RBI maintains the reserves of foreign currencies, which also helps to stabilize exchange rate and promote international trade. 6. Controller of credit or money supply. RBI controls the increase or decrease in the volume of money supply according to the monetary requirement of the nation. This is important so as to control the inflation and deflation in the economy by controlling the level of money supply in the market. More expansion of credit money or money supply can lead to inflation, whereas huge contraction of credit money results in deflation. While checking these, RBI stabilizes general price level and increases the output. 7. Regulator of the banks. RBI is entitled by regulatory powers under the RBI Act, 1934, and the Banking Regulation Act, 1949. Regulations relate to licensing of banks, expansion of the commercial banks in terms of their branches in the country or abroad, prescribing minimum requirements of paid-up capital and reserves, etc. RBI is a statutory institution. As per Indian Coinage Act, 1906, coins can be issued up to the denomination of 1000 rupees. As per the RBI Act 1934, currency notes can be issued up to the denomination of 10,000 rupees. The 1 rupee note is the only currency which bears the signature of the Finance Secretary of the Government of India. Currency notes printing and coins minting. Currency notes are printed in 4 presses in India. 2 of the currency note printing presses are owned by the Geoland, 2 are owned by RBI through its wholly owned subsidiary Bharatiya Reserve Bank Note Mudran Limited, BRBNML. The Golond presses are at Nasik, Western India, and Devas, Central India. The other 2 presses are at Mysore, Southern India, and Salboni, Eastern India. Coins are minted in 4 mints owned by the GOI. The mints are located in Mumbai, Hyderabad, Calcutta and Noida. Liabilities of a bank. Deposits received by a bank are considered as liabilities to that bank as it has to pay back them in future. The following are the categories of liabilities a bank has. Demand liabilities. 1. These are liabilities which banks have to pay on demand. They include 2. Current bank account deposits by account holders. 3. Demand liabilities portion of savings bank account deposits by account holders. 4. Margins held against letters of credit guarantees. 5. Balances in overdue fixed deposits. 6. Cash certificates and cumulative recurring deposits. 7. Outstanding telegraphic transfers, TTs. 8. Mail transfers, MTs. 9. Demand drafts, DDs. 10. Unclaimed deposits. 11. Credit balances in the cash credit account. 12. Deposits held as security for advances which are payable on demand. Time liabilities. These are liabilities which banks have to pay after specific time period. They include 1. Fixed deposits. 2. Cash certificates. 3. Cumulative and recurring deposits. 4. Time liabilities portion of savings bank deposits. 5. Staff security deposits. 6. Margin held against letters of credit, LOC, if not payable on demand. 7. Deposits held as securities for advances which are not payable on demand. 8. Gold deposits. Other demand and time liabilities. These include all those miscellaneous liabilities which are not specified under the above 2 types of liabilities. They include 1. Interest accrued on deposits. 2. Unpaid dividend. 3. Suspense account balances showing the amount due to other banks or public. 5. Participation certificates issued to other banks. 6. Cash collaterals, etc. Total demand and time liabilities, DTL, includes items mentioned in 1, 2 and 3 above. Net demand and time liabilities, NDTL, is equal to DTL assets of the bank with other banks. Assets of the bank include assets of the banks with other banks, advances by bank, investments by bank and money at call and short notice.